Hello everyone, it's Angie from UK Money Wisdom, and I've got a video here today that's going to get you all thinking. If you have a pension, many of you do, or you're approaching retirement, many of you are, there is something very important most people are never clearly shown. And it's not which investment fund to choose or which bank account to use. It's something much simpler than that. It's understanding how the whole financial plan actually works. Because many people are given a financial plan, but never shown the simple structure underneath it. And when that structure isn't clear, something very common happens. People start to second guess the plan. They wonder whether they're doing the right thing. They worry that something important might have been missed, and indeed it might. And not because the plan is wrong, but because the logic behind it hasn't been explained clearly enough. You see, financial advisors are usually very skilled. They understand pensions, they understand investments, they understand tax rules, but advisors often focus on building the plan itself, what investments to hold, what tax wrappers to use, and what withdrawal level might be sustainable. But what many people never see clearly explained is the simple framework underneath the plan. And once you understand that framework, something very interesting happens. Retirement stops feeling complicated and starts feeling manageable. So today I want to give you the information that will increase your own financial knowledge and make you far more financially aware. Let me show you 5 pillars that sit underneath almost every financial plan. And once you understand these 5 pillars, you will see why retirement plans are built the way they are. And the 3rd pillar is the one that quietly catches many pensioners out. Most people don't even realise it until they are already retired. Let's get stuck in right away. Pillar 1. Financial advisors often use a term called decumulation strategy. In simple language, it means where your retirement income actually comes from. Most retirees, you see, do not rely on one source of income. Instead, retirement income usually comes from several different places. And you can see above that perhaps a typical retirement income would have the following sources. You've got your state pension, which is currently £11,973 for 2025-26, a workplace or a private pension, which may be about £12,000. You have savings interest, I hope, if you're fortunate, of £2,000, something like that. And you have ISA withdrawals, which are flexible, as and when you need the money, perhaps. And each of these sources behaves differently within the tax system. Some count as taxable income, and that's where we have to be careful, because some do not. And understanding that difference is extremely helpful. For example, in the 2025-26 tax year, the full new state pension is about £11,973, as I said. Personal allowance, fixed, frozen at £12,570. So your headroom before you start paying income tax is £597. So the state pension sits just £597 below the income tax threshold. That means even relatively modest additional income can start to create tax. The table above shows you how different income sources are taxed, which you might want to look at for a moment. State pension, workplace private pension, both these count as taxable income. Savings interest, sometimes. It just depends on your allowance threshold. And ISA withdrawals, no, they don't count as taxable income. But I've done enough videos for you, hopefully, to know that. This is why retirement income often comes from a combination of sources rather than just one. And once you understand that structure, the logic behind retirement plans falls into place and becomes much clearer. Pillar 2 is understanding your cash flow. And that's what is actually happening month to month. This second pillar is something advisors call cash flow planning. You see, financial planning software can project how long your money might last. It can test different scenarios. For example, what might happen if inflation rises? What happens if markets fall? What happens if spending increases? These tools can be very helpful, but they still rely on assumptions, don't they? If we know real life spending happens through small, everyday decisions. And that is why spending awareness matters. Take a look at this simple example above. Just look at how small daily spending adds up each day, over the week, and over the whole year. It's amazing when you see it put down like this as a table. Although spending £15 per day does not feel particularly significant, that does become £3,900 per year, and that is significant. And what's more significant is that over 10 years that becomes just under £40,000 at £39,000. That's very significant. And that's £15 per day. That doesn't mean people shouldn't enjoy life. It simply shows how small habits quietly shape financial outcomes. And it doesn't mean that you have to go without everything. It just means setting something aside for something that you can do without, even cutting down on going out for a coffee and perhaps in the summer going to a park. Something like that, taking a packed lunch instead of going into a restaurant. Loads of ways you can save money. Let's move on now to pillar 3, understanding the tax structure around your savings. And this is the pillar that often surprises people. Financial planning is not only about how much money you have, it is also about where that money sits within the tax system. You see, the UK system includes several structures designed to help savers. You have your personal allowance of £12,570, your ISA allowance of £20,000 every year, and dividend allowance of just £500 per year. Unfortunately, that has gone down significantly. And we just have to accept that the government is cutting back on allowances. And that's why, for example, we have this personal allowance that's been frozen of £12,570. And fiscal drag is something we live with. But the point I'm making is that these structures influence how income is taxed. So let's look at a simple illustration. Say you're lucky enough to have £50,000 savings at 4%. Now, outside of an ISA, each year the annual interest is £2,000 and your tax would be £400 at 20%, and you would receive of that £2,000 of your savings just £1,600 after giving £400 over to HMRC. If you have an ISA and you take out £2,000 of it, your tax is £0. And what do you actually receive that you can spend? £2,000. None of it has gone to HMRC. Get the picture? Same savings, same interest rate, but a different tax structure. Over time, these differences compound. which is why ISAs often play an important role in retirement planning. Let's break for what I call a story moment with David and Sheila. And this shows how this structure can work in practice. It's a hypothetical example, but it reflects many real situations. Just imagine a couple called David and Sheila. State pension combined is £23,946. They're lucky enough to have a workplace or a private pension of £14,000. Savings interest is £2,400. And their ISA savings amounts to £120,000 in total. Initially, they assumed they would simply take extra income from their pension. But they learned something important, because the state pension already uses most of their personal allowances. They thought additional pension withdrawals could quickly create tax. So instead, they think, let's balance our withdrawals. Let's take some income from our pension and some from our ISAs. And that will help keep our taxable income more stable. And once they understood this structure, you see, their retirement plan suddenly made much more sense, and they saved from not having to pay so much income tax. Pillar number 4 is what I like to call the emotional confidence. And this 4th pillar is rarely discussed openly, but it is often, you'll be surprised, the most important. Financial advisors sometimes call this behavioural coaching, helping clients stay calm during market movements. When people understand where their income comes from, where their savings buffers sit, how their investments are structured, they tend to feel much calmer during market volatility. Understanding structure creates confidence. Finally, let's look at the 5th pillar, the financial buffer. You see, financial plans often assume life moves smoothly, but real life rarely does. Unexpected expenses happen, don't they? A boiler might fail, a car needs replacing, a roof might need repairing. And this is where a financial buffer becomes extremely valuable. Some people call it an emergency fund or emergency buffer, same thing. And here's an example of such an emergency buffer, showing your essential monthly spending and a suggested emergency fund that you should hold in case something does catch you out unexpectedly. Having this buffer means unexpected costs don't disrupt the entire financial plan. Instead, you have flexibility, and flexibility brings peace of mind. It's extremely valuable in retirement. I like to bring things all together towards the end of the video, so that's what we're going to do now. In this visual above, you can see the 5 pillars and what it means in summary. So the first one, income structure, is where retirement income comes from. Cash flow awareness is the second one, and what it means is understanding spending patterns. Tax structure is using your allowances efficiently. The 4th pillar is the emotional confidence to stay calm through uncertainty. And the last pillar was the financial buffer, which is having reserves or an emergency fund for unexpected events and costs. A financial advisor may help design the map, but you are still the one driving the journey, aren't you? And understanding the structure behind the plan will help you drive it with confidence. So here's a final thought for you. Financial confidence rarely comes from complicated strategies. More often it comes from clear understanding. Understanding where your income comes from, how your spending affects long-term stability, how tax rules shape your savings, and why financial structure matters. That is what I try to explain here on UK Money Wisdom, so people can make calmer, clearer decisions about their finances. If you found this helpful today, perhaps you'd like to subscribe and like the video. If you know of somebody you care about who could use this information, could you please share it with them? And please remember finally that the content I produce is for general information only, and it's not personal financial advice for anyone. You need a financial advisor for that. But it is based on current UK tax and pension rules and public guidance for the 2025-26 tax year. You must all realise that individual circumstances do vary and rules can change. So that's it from me today. I'll be back very soon with another video, and in the meantime, stay well and enjoy the day. Bye for now.